Namaste, investors. Today, we are facing an unprecedented times. On one hand, inflation is skyrocketing across all the economies, while on the other hand, हर जगह wars ही wars चल रहे हैं. But despite all this, equity markets are at an all-time high. So what explains this dichotomy? Well, we recently invited Mr. Ritesh Jain, CIO of Pinetree Macro, to voice his opinions on how to understand the macro view at this moment. So this is the recording of the 60th Investing Carva session. Do watch the session.
Hello friends, I am Ankit Kanodia from SmartSync Investment Advisory Services, a SEBI registered firm. Welcome to the 16th episode of Investing Carva, a Mission Smile initiative where we invite investing stalwarts every month and learn from their vast experience in the investing field. For those who are joining for the first time, Mission Smile stands for Making New Stock Market Investors Learn It Through Engaging Research. Before we begin, I would request everyone to please keep yourself on mute and switch off the video so that we can have a seamless discussion and soak in all the wisdom. You may type in your questions on the chat box. In the end, we have scheduled time for your questions. So let's begin. Today, our guest is Mr. Ritesh Jain. Mr. Jain is a well-known investment professional with over 2 decades of experience in investment management. He has held many senior leadership roles at organizations like BNP Paribas and Tata Mutual Fund, where he managed funds in billions of dollars. He is currently co-founder of Pinetree Macro, a global asset allocation theme investing fund. Additionally, he serves as the economic advisor to Old Bridge Capital Management, an HNI-focused portfolio management company that oversees Indian assets worth $1.1 billion. Mr. Ritesh was listed as one of the top 3 economic and financial influencers on LinkedIn in 2019. He is also a recipient of numerous national and international awards in the field of fixed income and equity investments. The title of the session today is Brave New World. We have borrowed this one from one of his recent presentation to CFA Society. Thank you so much for agreeing to do this, Ritesh. So let's begin. We'll start with an opening remark from your side and then straight away get into the questions.
Thanks, Ankit, and thanks everybody for joining us. As the title, I have put it on the first slide, Brave New World. You'll realize why I have put this thing, Brave New World. So there's just a little bit story behind it. I think COVID changed the world. Before COVID, you could say it was a different world. Post-COVID, it's a completely different world. And I call this as a brave new world for the simple reason because the way you used to think, the way you used to invest has changed dramatically. It was changing actually for some time, but there is an inflection point in every asset. That inflection point was achieved in 2020 because of whatever happened after this COVID. So I will cover some of these things in the presentation which I have put in together on some of the questions which Ankit has. So Ankit, let's just start. Yeah.
Thank you. Thank you so much. So before we start the questions, please share a little bit about your early days and evolution as an investor over decades. That will help our viewers to ask you relevant questions after your presentation ends.
Yeah, sure. Yeah. So I have traded in foreign exchange, currencies, foreign exchange derivatives, FX sales very early in my career. But then I found my calling at bond trading desk. Bond trading requires understanding of macros. I became head fixed income in 2007, and by 2012, I became CIO at Canva Rubico Asset Management. I joined Tata Mutual Fund as Chief Investment Officer for Equities, Debt and PMS in 2013. And by the time I left in 2018, we were managing almost 46,000 crores. Today, 46,000 crores is actually a chump change the way industry has grown in the last 5 years. So after global financial crisis is when I realized that macro and liquidity is becoming equally important for all asset classes, including equities. After COVID hit, I saw one more change. Not only liquidity is becoming increasingly important, but governments have also started becoming powerful. And that's why you have this first chart. Governments are becoming a bigger part of economy, reallocating capital and deciding winners and losers. Hence, as an investor, it was like dream coming true. I have successfully implemented macro and liquidity framework in both my personal and Pinetree asset allocation. But let's look at this chart actually. This is Indian government expenditure as a percentage of GDP. Most people might not realize that 30% of all the GDP in the country is created by Government of India. And if you're just awing and getting surprised, don't get surprised. In Canada, it is 40%. In Western world and G7, it is 40%. So can you think of an economy where 40% of the GDP, the expenditure on that GDP comes from the government? Can you see how in India it has grown over the period of, in 2011-12, we were 26-27, post-COVID, we are at 31%. And on the right is just the latest chart from Morgan Stanley. Central government capital expenditure has more than doubled since 2019. So can you see who's calling the shot? It is the government who's calling the shot. Liquidity plus government are the two most important concepts people need to understand if they want to be a better investor today.
Sure. So moving on, my first question to you would be, well, see, Ritesh, these are unprecedented times in terms of global macro and geopolitical situation. At one end, the inflation in the US and almost all large economies is going over the roof. On the other end, wars have been going around for the last 2 years. Earlier, it was Russia versus Ukraine. Now, Palestine's attack on Israel. With this backdrop, the equity market world over has been fairly resilient. I don't think that there is any debate on whether macros are important or not. They really are. My point is, are they useful for an investor to prepare and act efficiently in portfolio construction? I think this can be a good point to kickstart our discussion today.
So let me first tell you about, the war. A contained war which does not lead to permanently higher oil prices is good for asset markets. Let's talk about that thing. So war leads to spending. Everybody agrees. War leads to spending. Spending leads to rising liquidity, which is done by printing money, which is further accommodated by central bankers or borrowing money, right? So let me give you a recent example. Russia invaded Ukraine on February 24, 2022. It rattled global markets. In the US, the S&P 500 just, I think they fell 7% in the days and weeks immediately following the incursion. As the US and other nations stepped up severe economic sanctions on Russia, and investors worried about the impact of commodity prices also. But a month later, markets had rebounded and S&P was trading at a level higher than that of invasion, in spite of $100 on oil. The same thing was evident during Operation Desert Storm. So war is bad for people who are caught in the war, but it is generally good for economy and for asset markets. So unless the world is coming to an end, unless oil prices are going $50 higher, because India is sensitive to oil prices, right? Unless these two things are not happening, just forget about that thing. Go ahead, keep on investing the way you are, but think about it. Every war leads to higher liquidity. Every war will lead to higher spending. You have to find where the spending will be. I know it's not a very sensitive way of saying, because you are looking at only profiting from the war. There are people who are caught in the war. So yes, you have to be cognizant about that thing, but investing is completely different.
Okay. So my next question is, I'm sure many of our participants also know about him. The famous author and academician Nassim Taleb says, don't tell me what you think, tell me what you have in your portfolio. I won't ask you what you have in your portfolio today, as I don't know if you are comfortable sharing it or not. But I would like to share with, I would like you to share with us what you did in your portfolio pre-COVID, what you did during the pandemic, what worked well, and most importantly, what didn't work. I think that will give us a very good idea as to how you invest and what is your thesis.
So we are allowed to share our portfolio, but let me start with that thing. Okay. First of all, people need to understand that thing, and this is a Vanguard study. It is there on Pinetree website also. According to Vanguard, 88% of investors' returns are attributable to asset allocation, and liquidity helps me in deciding asset allocation. So this is a portfolio of Pinetree. If you look at the portfolio of Pinetree, I just mentioned 5 things over here because people are getting very excited about these assets. One is the uranium miners. People are keep on talking about that. And these days, uranium, nuclear. I started Pinetree in August 2022. It was 8.5% allocation in 2022 itself. People are talking about Japan now. I looked at Japan 2 years back and said Japan will be one of the best performing market, but Japanese yen will not do well because they are doing yield curve control. So we have DXJ over here, which is the only currency hedged ETF in the world where you're not getting a downside of yen, but you're getting an upside of Nikkei. During all this time, I was having zero bond. I've just picked up bonds. And then Mexico was a simple. I had written about Mexico so many times that Mexico was simply the biggest beneficiary of USMCA because US wanted reshoring, friendshoring, it wanted supply chain back. And companies said, let's reshore to Mexico. Mexico has a young population. We will make for Mexico. We will make it cheap and we will export to US and Canada. This year, Mexican peso is up 20% against Canadian dollar. Canadians love to go to Mexico for vacations in winter. This year that vacation is over because it's already 20% costlier to go to Mexico. So you can see in front of you, this is how the allocations have taken place. And SPDR gold shares is again one of the top allocations for the simple reason. It's not, yes, I'm biased towards gold, which everybody knows about it. But in February 2022, G7 countries sanctioned Russia's FX reserves. They sanctioned Russia's FX reserves. And if my FX reserves are not safe, okay, then why should I be adding to US dollar in my FX reserves? From that time onwards, I added gold to my portfolio. And these are all macro calls. I do not know which companies are there in Mexican ETF. Yes, in Japan, we would all know that Toyota will be there and Mitsubishi will be there. But if I have to name the top 10, I will not be able to name the top 10. Does it matter? No, it does not matter. You are taking a macro call. Now, the important thing is if this was the portfolio, what was the returns, right? And these returns are these returns comes from our custodian. On the left is the returns versus the benchmarks. And the benchmarks are global benchmarks. Because I am allowed to invest in real estate, REITs, oil, gold, equities, fixed income, it's but natural that you should be able to compete against all of them. So now we've completed 1 year, 3 months of this portfolio. You can see the dark blue line is the returns of Pinetree. Then you have the return of VT, which is the Vanguard Total World Index. BND is the World Bond Market Index. SPY S&P 500. This is in spite of having zero allocation to Magnificent 7 or NVIDIA or any of the tech stocks. What I don't understand, I don't understand. Okay. On the right is, as happens in India, we never used to compare ourselves to benchmark alone. We used to compare ourselves to other competitors. That is the reality of our life, right? On the right is, you will see Pinetree versus BlackRock Global Multi-Asset Income Fund, Fidelity Global Multi-Asset, PIMCO Global Core Multi-Asset, and this is the return versus them. It's a very simple thing. And I will show you one more thing. Similarly, I have also started experimenting with ETF in India, and this I must tell you that is a proprietary money. Okay, that is a very clearly that is not auditable. This is audited. Okay, this comes from our custodian. Sorry, I'm not 100% there. So similarly, I have started experimenting with ETF in India, as we have a wide variety of ETF in India, and as you know, by next year we'll be having tons of ETF coming because of that Geo BlackRock. So this portfolio was started with our own proprietary capital in August 2023 with returns till October 2023. Okay. So although I understand it is too short a time period, but initial signs are very encouraging. I have a macro view about flow of liquidity in India, where it will go, and which we will discuss where the flow of liquidity will go in India. And luckily there are ETF though, which you can execute your views, and what you can see on this slide are the returns of the portfolio. You can also see on the right which are the ETF I've used What I have not shared with you is a percentage allocation to each of them. And I'm comparing not only with Nifty. For me, Nifty is not the benchmark. Nifty 250 is the benchmark. Okay. So this is very simple. Does it work? It is too early days. I know it is early days. And I would have preferred even some better ETF to represent my views. But I'm happy with what I'm having as of now. And I'm very excited with that launch. Because as I just explained, 88% of the investors' returns are due to your asset allocation. Get your asset allocation right. And if you want your asset allocation to be right, you need to understand macro and liquidity. It's simple.
Fantastic. So I have a follow-up on this since you mentioned India and Indian ETFs. So all we know is over the last few years or maybe 10 years, Indian ETF basically or equity ETF basically meant Nifty ETF or Sensex ETF, right?
Yeah.
But nowadays, what we are seeing also that some of the new funds are getting launched where you are seeing total market ETFs as well. So
Yes.
would you like to share something about that? Because many of our audience are still not very aware of, because you have a global experience, you would be able to compare these ETFs with the global ETFs, right? So I would like you to expand on what is the difference between a Nifty ETF and a total market ETF, and which one is better and which one has what kind of risk. I think that would be very helpful.
No, Ankit, I will not be able to do it. I am not an expert on that. I was looking at a theme to execute my view. And suddenly I saw, okay, then I looked at all the ETFs, the one which were liquid, and I said, this one fit my views. Beyond that, my understanding is limited. You'll have to find somebody else who can explain. But I must tell you one thing. If you have a good macro view and a liquidity view, 88% of the returns, 80% of the return is asset allocation. And for asset allocation, you don't need to go to active funds. Yes, active funds have their space. If you get the right narrative, if you get the narrative right, there is an ETF which will be there in the next 1 year in India. Today, it is not there to a large extent. Like in US, there are 2,000 listed ETF, 500 of them are very liquid. So think of a view under the sun, and you have a ETF in US, okay, to represent that thing. In India, it is still a nascent market. Although in the last 2 years it is growing, it will take time for people to get used to that thing. And as it is today, incentives are more aligned towards active managers than passive managers. But what I've seen in US and Canada happens in India 5 years later. Like in US and Canada, more money is now going into passive, less money is going into active. Okay. In India also, over a period of time, you will have few active managers who know their, who are the real bottom up stock pickers, seen 20 years of, career cycle. But rest of the money, why should it lie in active fund managers when 86% of them are not beating their benchmarks in large cap? This is the evolution of, this is how in economy, it has nothing against them. It is the democratization of information. It's a simple process.
Right. So moving on to the next question, Brave New World, your presentation in the CFA Society India webinar was a brilliant one. And actually, I must confess, I first saw you there only and was blown away by the clarity of thought and the simplicity with which you explained your thought process. You mentioned about liquidity and Mr. Stanley Druckenmiller. I would like you to expand on both liquidity and Mr. Druckenmiller a little more before we move on to our next question.
Okay. If you have to follow one person in the world today for liquidity, who actually speaks his mind, who doesn't speak his book, these are two different things. Simply because he's not managing public money. Since 2013, he stopped managing public money. He manages only his private money, which is his family office, which obviously runs in billions and billions of dollars. And the clarity of thoughts. Every time he speaks, I must, people who want to get up to the learning curve of investment must listen to him. So this is what he said in 1998. It's a very simple thing, nothing more than that. So let me explain a little bit. In any business cycle pre-Lehman crisis, okay, central banks used to use only interest rates as a tool to influence the direction of economy. But post-Lehman, they not only cut rates, but expanded their balance sheet by outright adding liquidity. They added liquidity by buying assets from market, thereby influencing the asset prices. And it has continued since then. This has been replicated by Bank of Japan, European Central Bank, Swiss National Bank, and PBOC. And I will come to what RBI is doing also. So every small crisis since 2009-10, if you know in economics, there has to be a proper business cycle. But recessions are getting shorter because of central bankers and liquidity intervention. Okay. So every small crisis since 2009-10 has been met with more emphasis on adding liquidity rather than interest rates. The most recent example is when Silicon Valley Bank, which is a recent example, was under trouble. Fed introduced a funding facility for banks to borrow against their treasury holding without taking any haircut on those bonds. So banks have borrowed 150 billion in this facility already. Another example is what is currently going on in China, where President Xi went to PBOC. When was the last time you saw a president of a country visiting the People's Bank, of a central bank of the country? Think about it, implications that you are giving so much importance to the central bank of the country. This is when, which outlines the importance of PBOC in stimulating the Chinese economy. As per cross-border capital, and they are the authority on liquidity, PBOC has pumped $1 trillion in Chinese economy since June, but keeping interest rates steady. So can you see they're not touching the interest rate? They're just doing by liquidity. Even in India, RBI is now focusing more on liquidity than interest rates to manage the economy. So you need to absolutely take liquidity into account when investing, because interest rates alone have lost their ability to stimulate or contract the economy. Now, important thing is, just see where this liquidity, you can see the liquidity going, increasing or reducing. You can just type it on Bloomberg. You'll come to know about it. Important thing is, where is this liquidity going? This liquidity has been going only into US mega cap tech. Just see the correlation. These are two different people, two different charts. On the right is cross-border capital, who every week they have a proprietary models with 80 indicators. And they keep on saying what is happening on the liquidity side. From the time Fed has started doing QT, have you seen the markets have flattened out? Nasdaq is not making a new high, right? Because they're taking out liquidity. Only in the last 1 week, Fed has started adding liquidity. US Treasury did something which led to increase in liquidity, which led to 8 days of rising in Nasdaq. All 8 days, all because they did something last week on Wednesday. Market just went bonkers because what they did, they added liquidity. What did they say? They say we will not borrow in long term. If you do not borrow in long term bond yields goes down. When long-term bond yields goes down, financial conditions ease. When financial conditions ease, it leads to increase in liquidity. When the liquidity increases, it goes into asset prices. Which assets it is going into? It is going into US mega cap techs. It's a simple thing. Apple came out with the results. It was very bad results. But the stock continues to go up. Why? Liquidity. Nothing more than that. So this is how I explain the liquidity part.
Brilliant. So I'll just carry forward that liquidity topic in my next question as well. So most of the people who are attending this live or will probably watch the recording are fundamental investors investing in the Indian market. If we extend the liquidity argument in our context, India over the last 20 years has always got more liquidity than ever before, year after year. Of course, there have been a few odd years like 2008, 2013, demonetization time, and maybe during the COVID times, but where liquidity dried up for a while. But directionally, we have always got more liquidity progressively. And even today, most experts say that India in the next 10 years or maybe 20 years will see a tsunami of liquidity. Then why get into this hassle of trying to predict what the liquidity will be in FY24 or FY25? Is there any merit in doing that? If yes, how easy or difficult it is to do that or get it right?
It's a very valid question. It's a very valid question. And it took me, since you had sent me this question before, I actually spent a lot of time on understanding. So you have a point. increase in liquidity or reduction in liquidity is easy to see or predict. Okay, you know what your central bankers are doing, you know they will do QT, right? And all those things, you know what RBI wants to do OMO. Okay, but what you also need to connect the dots about where this liquidity will finally reside. Okay, which sector, which part of the economy it will reside. In the previous chart, you saw that liquidity created since 2012 just resided in US mega cap tech, and these mega cap tech are now struggling because central banks are not easing liquidity at margin. Now, let me tell you how liquidity behaved in last 20 years in India and how I think it will pan out in future. That is what everybody wants to know, right? So India leapfrogged physical infra and created a world-class digital infra, which everybody knows about it. Add to that our command over English language, and you created a lopsided services-led GDP, right? A small part of population working in services, which coincidentally also reside in metros, were the big winners. As per some estimates, services create only 20% of the jobs created by manufacturing. Hence, countries go through this path of manufacturing first and then services. Okay, that is when you become rich, you become services. Okay. Now, this also led to services becoming big part of benchmarks. 50-55% of our benchmarks are actually made up of BFSI and IT only, no? Right? Which is a reflection of the profits in the overall system. What if the future liquidity will bypass services and goes to manufacturing? Fine, we are talking about liquidity only. Okay. You can already see the stagnancy of the benchmarks, right? See the stagnancy of the benchmarks? If India is going to be producing goods for whatever reason, import substitution, fiscal incentive, China plus one, then the incremental profits will shift from services to manufacturing. Apple will make 7 billion of phones this year in India, and in next 5 years, it will make 40 billions of phone in India, right? The profit ecosystem is going to change. Prosperity will come near centers of manufacturing, which coincidentally do not get housed in metros. This will have rub-on effect on tier 2, tier 3 metros, where you can already see the resurgence. So as I mentioned before, getting a hang of liquidity is important, but what is equally important is direction of the liquidity. Now, let me tell you in this, I have not extended further. We were making $29 billion of electronics in 2015. We are making $105 billion of electronics in 2023. At the Morgan Stanley chart, where by 2032, we'll be making $600 billion of electronics, which will be 8% of the GDP. Can you see where the liquidity is going? Now, important thing. You created physical and digital infra, but you never created physical infra, right? See what is happening on physical infra. Connect the dots. Manufacturing over services. Tier 2, tier 3 over tier 1. It's a very simple process. And in debt, as we become institutionalized, private debt over AAAs. So yes, I completely agree. India is in a sweet spot, non-aligned, everything. Liquidity will come to us. I know today that all your small and mid cap, what you talk about, Shoe Shiner has started asking for the price of the stocks and which stocks to buy. But I strongly believe in the coming years, unless the composition of benchmarks change, money will be made outside the benchmarks because benchmarks are service heavy. Mumbai real estate prices have not gone anywhere for 5 years. They will not go anywhere for next 5 years. Same thing with Delhi. But try looking at Gurgaon, try going to, Sonipat, and you see the difference. So wherever roads will be made, these industries will not be housed in metros, these manufacturing units. This will create jobs, the most important things. Today, India is spending without creation of jobs. Household spending, like, I called it that Zindagi Na Milegi Dobara spending. After COVID, everybody wants to do that thing. Now we will be creating jobs, $600 billion of electronics manufacturing alone. I'm not talking about chemicals and then pharma and then other things. I'm just talking about this one because this is most researched part of India's economy, which is undergoing, right? $600 billion, 8% of the GDP by 2032, growing 22% per annum. So I've answered your question on this thing. Very simple. In a very simple way, just connect the dots.
Brilliant. So, Ritesh, my next question is again related to that comment you made in that CFA presentation, where you said that basing your decisions on businesses that did well in the last 20 years is going to be a big challenge for us. It is a brave new world. A lot of these businesses will lose pricing power and face other new challenges. I want you to expand on the same from the Indian context if possible, and a few examples would be awesome.
I'll give you two examples from Indian context. From global context, it is much easier because I spend more of my time on global markets. Okay, I just extrapolate that to India. Now, technology and regulation is going to flatten the curve for highly regulated business in India. Okay, like banking, asset management, and insurance. Whereas it will be beneficial for wealth managers. Why? One is not regulated enough. Okay, but the others are heavily regulated. Correct? Okay. I had already written about it so many times in the last 1 year. Can you see how the market cap has moved over the last 1 year? From the heavy regulated ones to the less regulated ones. It was a simple process. Okay, this was one. The second one is, another sector is going to be energy transition. Why? Why is energy transition? What is energy transition? This one will be because of government prioritizing energy security. Government post-COVID have become bigger at the expense of private sector, which I had already shown you, okay, in the first chart, and are deciding winners and losers. They are reallocating resources. Hence, some businesses in fossil fuel will continue to lose PE multiples, whereas others in electrification will gain profits and earning multiples, not because that is how it should be, but that is how government is reallocating incentives. So follow government policies, and follow government reallocation of resources and economy in this brave new world. So this came out from Hitachi India's yesterday. They came out with results. What did they say? It's a very simple thing. It also means adding an equivalent of the European Union's entire existing grid by 2040. You want to do manufacturing? You need to do electrification. But I also must tell you, if you want to do industrialization now, pollution will only get worse. Unless we do electrification. We cannot do manufacture. We cannot do industrialization by adding more coal plants. So this is just one downside I'm just going to tell you over here.
Great. So I'll again pick up a point which you mentioned in one of your presentation or interview, where you mentioned that the age of weaponization and why Russia, China, and Europe are uninvestable. You have already mentioned that in today's presentation also. Where do you see India in this? How much of an advantage India has in this context?
Oh, so where will you find a young demographics, non-aligned English-speaking people of a country which is a soft power? Huh? Soft power. Nobody gets threatened by you. Okay. In today's world, this is a very, very important quality. World is finally fragmenting, and owners of capital and people with capital to deploy are looking to invest their surpluses away from Western world, US and even US treasuries, into something more tangible. What better than invest in 1.3 billion people country, which will not confiscate your technology, neither threatens you, but welcomes you with open arms. Whether it is because of PLI, import substitution, or China plus one India. I think India is in a sweet spot. And the only question is whether we have the capacity to absorb a very large pool of capital in our real economy. Look, this money which Saudi Arabia and UAE is getting, any oil surplus country is not reinvesting back. They would want to do it with India, okay? At least Middle East countries. But do we have such big projects to absorb that money? And this money is not coming to financial economy. Money is not coming to markets. This money is coming to real economy. They also want to build up assets for their future, where they get the annuity. People are saying, Japan, they have excess capital, but for their old age, they need cash flows. What better place than India? I'm saying, forget the FII part. And I know even FDI is not picked up. I was just looking at recent numbers, but it just started. Give it some time.
So what do you say? I just have a follow-up on this point which you mentioned right now, Ritesh. Is it a wonderful time for an Indian asset manager to start a fund in India and try to gather foreign assets?
Absolutely. At least from G7, look, the debt to GDP in Western world is so high and the GDP itself is so low that there are no growth opportunities. In fact, on this, since I can introduce over here, I'm starting nrizen.com, which is for non-resident Indians to invest in India. Look, non-resident India, which will be, I think by 1st January will be ready. Non-resident Indians historically have invested in Indian real estate. They've not participated in India's growth. Okay, which was right. Currency was depreciating, and when currency depreciate, real estate asset do well. What if 5 years down the line, INR does not depreciate against Canadian dollar? As it is for the last 5 years, INR and CAD is same. Who would have thought an emerging country like India will not see a depreciating currency against whether it is sterling, JPY, Canadian dollar? Okay. So incrementally, I believe if the currency is not going to depreciate, this NRI money, one, it will not stay in their country because there are not growth opportunities in G7. Secondly, it will not invest in India's real estate, but it will come into India's financial market. So I completely agree with you. This is a good time.
So moving on, actually, it's an extension of the earlier topic which we are talking about India. So a friend of mine keep on reminding me about the macro situation of India. I think he read it in one of the newspapers where I'll just quote that. India today is an excellent case of confluence between network effect and compounding. It took India 3 decades after 1991 to add $3 trillion. The next 3 trillion could come in only 7 years. This is a sight that nobody in the world can ignore. We are only a couple of years away from becoming the 3rd largest economy. As a bottom-up stock picker, I'm clueless as to what to make out of this for my portfolio construction. What would be your suggestion to India-focused long-only individual investors? Because those individual investors are most of our audience today, and maybe they will watch the recording as well. What is the opportunity for India? What are the risks and how to prepare for the same?
Okay, first, let me give you some numbers. Okay, in 2013, or let's say even before 2013, India's GDP was lower than Canada's GDP till 2012. In 2013, India's GDP and Canada's GDP was $1.85 trillion. In 2027, as per IMF number, it's not my number, India's GDP will be equal to Canada's GDP plus UK's GDP, plus Australia's GDP plus 25% of UK's GDP. This is how fast India is growing, and this is how stagnant the Western world is. Okay. Now, where are the opportunities? You can read the left part. I very clearly explained where are the opportunities in equities, fixed income, and real estate. And all because of top-down macro calls. I have no views. I don't understand equities. There are hundreds of people who have better view of HDFC Bank's result or any company's result, and they will be knowing till the last cent what will be the EPS of that. Think of me as the one who focus only on the earning multiples, where the earning multiples will go, which industry the earning multiples will go. And I'm telling you here the earning multiples will go. Now the risk, because the risk is the most important part. Okay, because so again, okay, so just connect the dots. The opportunity in my view is firmly outside the benchmark in equities because incremental GDP will come from manufacturing, then services. Okay, by now I've explained you that. At least key manufacturing, it is the numbers are staring in front of you. In debt, it is in high yield private debt because that is now quite mispriced. And in real estate, it is firmly in tier 2, tier 3 cities where we will see emergence of new millionaires. Okay. The biggest risk India faces is spiking of oil prices and not Fed rate hikes, because 90% of our oil needs are imported. Maybe 10 years down the line, we have the green and energy transition and whatever it is, but today it is a problem. So oil is the only thing where we have a problem. Okay. And I have written about all these things over the last 1 year when I wrote my annual outlook. Where are the opportunities? Okay. This is not what I'm talking today. I wrote it on January 1st, and then wrote again on April or May of this year, which is all there on Twitter and LinkedIn.
I think if you can read that out, or
I'm just saying Indian economy and markets are in sweet spot, but again, action will be concentrated out of benchmarks. Service-led growth in yesteryears led to prosperity, property prices rising sharply in Indian metros. Since incremental capital is directed towards manufacturing, property prices in large metros will stagnate, and those in tier 2, tier 3 towns will rise sharply. I wrote it on 1st January 2023. People just need to read, and you don't need to read. You're not saying that here comes a great thinker. No. If you sit in a room quietly, read 4 or 5 hours every day, you can all come to the same conclusions.
So I have a follow-up on this, Ritesh. As you mentioned about the kind of situation India is in compared to the other large economies. Increasingly, new investors in India, I'm talking about young investors, probably investors who have joined the market in the last 2-3 years or maybe 4 years. There is a fascination towards investing in US stocks. So this question is specifically related to individual investors having fascination for US stocks sitting in India. I'm not talking about NRIs or people who are based out of US, Indian citizens based out of US. I'm talking about Indian citizens who are investing in US. Do you think at this juncture, we should be investing in US is a good strategy, or what is your view?
Unless you are an HNI, don't do it. And why as an HNI? You have enough capital and you want to diversify. Let me give you a very simple numbers. Don't go by this magnificent 7. Out of these magnificent 7, all other stocks are down for the start of the year. US stocks are 2.5 times standard deviation costlier than Indian stocks. Rest of the world, not Indian stocks. India's nominal GDP will grow at 12 to 13% for years to come. I have some numbers. Corporate profitability is 1.3 times the nominal GDP. So India's corporate profit will grow as a whole 15 to 16% annually for years to come. Although if oil prices goes up, then I do not know. US nominal GDP will be 4 to 5%. The corporate profitability is 7 to 8%. I believe for an average investor who's not having a very large portfolio and not looking at asset allocation across geographies, don't go outside India. You're getting India is put in a very sweet spot because of whether it is Ukraine-Russia war, or whether it is because of China-US standoff, or whether it is because Middle East suddenly doesn't want to invest into US treasuries and they're looking for assets in India to pick up assets, highway assets or road assets, or whether it is Japanese investors saying, we are dying and we are old age society, we need income earning assets. Sweet spot. Don't do. Although I am a global investor, I am helping Indian investors invest globally. I am myself telling about those are evolved investors, have a very large network. For them, you should be having 5 to 10% globally, because you also go abroad to, for vacations, your kids want to study. That's a different thing altogether. But for an average investor, don't. Enough opportunities in India. And India is not Brazil or Argentina, where it's a one-tick, one-tick pony. You have very different sectors. Okay. So you will always find opportunities in India.
Great. That's very heartening to know. Because see, you are a global investor. So for you, India is just one of the asset class. And when it comes from you, we know that there is no bias. Like we Indian investors will always have that bias for Indian equities. That is why I posed this question to you, because I don't think you come with that kind of a bias, right?
No, I would not have. Look, the thing is, India has been put in a sweet spot after COVID. I would not have been so bullish pre-COVID. But today, there is a lot of money waiting to invest in real India. This will create jobs. This will give a multiplier impact to the economy. It will completely different. If oil prices, that's the only risk I see. Political risk, I don't understand. So I will not comment on that.
Right. So before we take the questions from the audience, I'll have last couple of questions for you. So in this brave new world, should investors be brave or scared or both, and why?
So, so you should be brave because governments are going to steal your money through financial depression and reallocate resources. You will be poor if you do not take risk. Follow the money, follow the liquidity, and follow what governments are doing, where they are reallocating resources, and invest accordingly. You will be fine. But don't listen to anybody. If you want to make money, making or investing, you want to build up capital, it's a hard work. It cannot come on reading on Twitter few lines and then investing it. It's a hard work. I read 5 hours, minimum 5 hours every day, including weekends.
Great. So since you touched upon the topic of reading, any books you would recommend to investors?
Yeah, avoid. I think there is a very nice one, easy to read for everybody. Avoiding the Punch by Louis Gay.
Can you repeat again?
Avoiding the Punch by Louis Gay. I think everybody should read it if they want to understand the liquidity part. And then there is a lot of free stuff on Twitter, but you should know which free stuff. You should follow Cross-Border Capital if you want to know more about liquidity. And these days, forget books. There are enough good podcasts. You need to know which one. Every time Druckenmiller is there, he's there once in 3 months. Why not spend 1.5 hours listening to him again, putting notes? What is he talking about? Why is he talking about? You can extrapolate everything to Indian, because India is not a separate island. India is a part of global universe. If liquidity contracts, it will contract in India also. If global liquidity expand, some of that will come into India also. It's simple.
Any podcast you would recommend? Any of your?
Yeah. Actually, you should listen to Luke Groman. I have a subscription, but he does every week. He does 5 to 8 minutes of video. You should listen to him. And there are, I'm not remembering, but I listen to a lot of them. Grant Williams, but again, that is behind the paywall. If you want to be a good investor, you have to pay. Whatever you're getting free, most free things are not good.
So there are a few questions from the audience. Shall I take that up now?
Yeah, sure.
So Harshal asked this: if you can share what can be the impact on liquidity and markets, as some major countries will have elections soon. Basically, how should a retail investor understand this situation?
Every time there is an election, unfortunately, liquidity goes up. It doesn't go down. Whether it is US or India, politicians are same. You cannot contract the liquidity when going into elections. You have to spend more money because people vote not based on what happened to over the last 5 years. They vote based on what has happened to in the last 6 months. If they feel good, they vote accordingly. So if somebody tells me next year every country will be having elections, I would say liquidity will increase. Same way, I strongly believe that US Treasury is building up cash balances to be spent just ahead of US federal elections next year.
Great.
So I will not be surprised to see weaker dollar in run up to the US elections. And don't mind me saying, we've seen historically in India also, whenever we've seen elections, we've seen increased spending, whether it is through subsidy or mostly it is through subsidy rather than capital expenditure.
Great. So Neeraj asks, any view on Brazil market amongst emerging market?
Oh yeah. Brazil is cheap, but Brazil normally remains cheap. But if you want to buy, there is one interesting thing with Brazil. Brazilian bonds are beating US bonds on returns. Their interest rates are very high. If inflation were to fall a little bit, then emerging market equities will start outperforming these Mexico and Brazil, because today the returns of my ETF are coming from currency. It will come from equity also of those countries. So I think if Fed stops raising the rate and starts going on the cutting of the rates, commodities will start doing well, and Brazil is rightly placed. I would say the entire Latin America is rightly placed because of that thing.
Okay, great. So Rohit asked this question: how do you see US recession impacting Indian equity markets, assuming oil prices being soft because of slowing global growth? Will it be business as usual in India, or we can see a temporary impact?
It's a business as usual in India. I would say that forget what is happening in US. If you look at it, these days we don't have that kind of correlation with US markets. And why are you looking at broad markets? If you look at underlying stocks and all, they don't care if Nasdaq is up 500 points or Nasdaq is down 500 points, right? So in this brave new world, India or all countries have become delinked. Okay, for the first time, uh, bond yield in Vietnamese bond is lower than the bond yield of US Treasury for the same duration. For the first time, emerging market bonds index yield is lower than US Treasury bond yield. The world is changing. The world is saying that US Treasury might not be the safest asset anymore. Countries are looking to reinvest that capital. So don't look at what has happened in US market. I have done my career in my career for the first 15 years. I've done the same thing. What happened in US extrapolated to India. Today, yes, you can extrapolate it to your indexes because FIs will sell and buy based on what has happened. But opportunities are lying outside the benchmarks. I've again explained to you. Why are you getting scared or why are you getting elated by what is happening in US? If you believe that this is the kind of electronics manufacturing which we'll be doing in the next 10 years, if you believe that electrification will double, there are enough themes over there. If you believe chemicals is right, I'm not understanding few industries. I don't spend that time. Why do you care about the broad indexes anymore? This actually after COVID is what I've started seeing, that broad indexes don't matter anymore to my observations. It should not matter to yours also.
So if I got your answer correctly, you mean to say that if anything happens in US or in global market, it may have a larger impact on the large cap or basically the index stocks. But if you go outside the index, it will be far less immune.
Yes.
Right.
And you should know what you're buying. Okay. I think there are enough SEBI has put enough checks and balances these days in a lot of stocks, which I can see. Okay. But you need to do your due diligence. Look, FIs own only large cap. They don't own to that extent the small cap because of the liquidity problem. Okay.
Right.
They have to sell those ones. Now, banking is a commoditized business. What is there left in the banking? Please tell me what is there. Anybody can replicate that business. The thing is, they need to have a huge regulation on that thing.
Right.
But every FI owns the same, same stocks.
That's why probably the large heavyweight banks are probably not doing so well over the last 3, 4 years, 5 years, except the PSUs. Right. If you look at Indian context.
That is what you'll have to connect the dots. That is how you'll have to connect the dots.
Right. So moving on to the next question. This is from Shivam. With US debt to GDP going up about like crazy, do we see any systemic threat to the current global financial system? And how real is de-dollarization to that effect?
So, US debt to GDP is 130%. Last time it happened in 1944. Since 1850, there has been only one other time in 1944 where US debt to GDP was 130%. So I will go back to 1944 and what they did it in 1944. They kept the bond yields lower. They allowed their inflation to move up. They reindustrialized their economy. And by 1952, their debt to GDP was down to 60%. What is US trying to do now? Their inflation is higher than the interest rates. They are trying to reindustrialize. Who knows by over the next, so that is known as financial repression. This is known as stealth default on your debt by keeping the bond yields lower than the inflation. So there is no risk. Yes, there can be an alternative. The alternative is Federal Reserve Bank says, no, I'm not going to fund this deficit. And then we all go into the Great Depressions of 1920s with bread lines. But I don't think that is going to happen. US is going to default on its debt by inflating away its debt. Defaulting on debt can be done either outright default or inflating away your debt. They will inflate away their debt. There's no doubt about it.
So, Umesh, how much real is this China plus one?
Yeah. So in a survey done of 2000 CFOs in North America, 2 years back, I have the report with me by BOFA, Bank of America. 86% of them said they want to reshore their supply chains away from China, and their top 3 destinations was Mexico, India, and Vietnam. I have the latest chart where profits being generated, multinationals profit generated in China are no more getting deployed in China, they are getting deployed elsewhere. Again, I will go back to the same example. Apple was making $7 billion of phone this year. 5 years back, they were making refurbished iPhone 5 in India. Okay, this year they have made iPhone 14 or 15, whatever it is there, I don't know, within 3 months of making it in China. In 5 years, they'll be making $40 billion worth of iPhone in India. Just think about it. Apple has answered your question. We don't need to keep on asking the same thing again and again, because if Apple is saying that thing, then everybody is looking at the same thing.
Right.
Make for India and export from India. So it will lead to 2 things. Fine, you can say your GDP can go up 2 ways. Either actually you produce more for domestic, or you reduce your imports. If you reduce your imports, your GDP will go up. No, it's a simple thing.
Right. So next question is from Chirag. He says, any views on US tech valuation? Because everyone knows recession is looming, but Nasdaq is near all-time high.
Look, every month flows, 401k flows have to get into the indexes. Apple's profit are lower than what it was 3 years back. Magnificent Seven's profit as a percentage of total profit in the pool was 31% 3 years back. Today it is 21%. But there is so much money which is following the benchmarks, and these companies keep on buying back their stocks, reducing the available stock also in the market exactly at the same point of time when 401ks have to buy these stocks because they're the largest in the benchmark. Can you see what is happening? You keep on selling the smaller ones, you keep on buying the big ones. I don't have any fundamental view. But this is liquidity working, unfortunately, in the wrong way. Can it continue? Yes, it can continue till the time they continue to buy back their stocks. By buying back your stocks, you're reducing the available stock in the market.
But then I would demand and supply.
It's all about, everything is about that. It's an economics 101. It has nothing to do with anything else. But the same phenomena of these large cap tech, they started buying back their stock in 2012-13. Okay. The same phenomena is getting started in Japan this year, where Japanese companies are sitting on huge amount of cash. They started buying back their stocks, and next year they are getting Japanese investors are getting tax exemption to invest in their Japanese stocks. So either you can continue to buy the same story, or you can go ahead and invest in a new story.
Right. So, Ritesh, next question is by Rohit, and I think this is a very, very, very important and interesting question. So, he says that what is your view on China's economy? Because we see softness in local demand resulting in significant dumping by Chinese in some sectors. Do you see this continuing for a long time?
So they are trying to rebalance their economy by going from export oriented to domestic demand oriented. When you are a developing economy, you need to get other person's GDP by exporting. But when you are $10,000 per capita, you need to have a domestic demand. The domestic demand has not got stimulated till now. So that's why they have continued to dump. But since the Western world is not taking it, they're doing it along BRI road, one belt, one road. Okay. In the short term, they have stabilized their economy because PBOC is now very clear that I am going to postpone your problems by buying your debt. It's always like that. You can always postpone the problem. Liquidity can solve any problem. Sorry, not solve, can postpone any problem. So PBOC is going to postpone this problem. we hope that they are able to convert that export economy into domestic consumption economy. But if they are not going, but then we have a problem. Chinese assets have not done very well, have not done well at all for a long period of time. Foreign investors are underinvested in Chinese assets, although as a percentage of benchmark, they're very high compared to India. So my view is just that I'm waiting for the domestic demand to kick in. If it does not, they have no choice but to keep on dumping to the rest of the world because they have the capacities.
Then that would lead to a problem or risk in Indian market as well.
Then the way everybody has put it, trade and tariff barrier, we will put more and more of that. We will erect. No, what have we done in electronics? What have we done in laptops now? 10 years back, we could have done that on laptops.
Right.
People would have laughed. You would have been taken whole to WTO, where everybody would have cried in WTO and India would have to take it back. Today, WTO doesn't exist. Nobody cares about WTO.
Right.
We can do what is right for us. I know it will lead to higher inflation. Please understand, India is an inflationary economy. If you want to make in India, it will come, the cost of that is, yes, you will create jobs, but it will come with inflation. But I think it is better to create jobs with inflation rather than just getting imports from abroad.
Right. I completely agree with that. Yes. So next question is by Neeraj. It's a very simple question. What is your view on gold for the next 10 years?
Yes, I don't have a view on next 10 years, but I strongly believe that over the next 3-4 years, till the time US debt to GDP stabilizes. So let me put it this way, US debt to GDP is 120 to 130%. Till the time it goes to 60 to 70%, I would want to be owner of gold rather than owner of US treasuries. As it is, there is a chart I am having, GLD divided by TLT, gold ETF divided by long bond, which is at an all-time high. More and more foreign central bankers are dumping US treasuries or not buying US treasuries and buying gold. So either we have a new reserve currency or US debt to GDP comes down to 60-70% by reindustrialization and all. At that point of time, I don't require gold. Till that point of time, gold has given 12% CAGR in India, not in linear terms, okay, for the last 23 years. I think it is going to continue giving that.
Right. So Rohit asks a question which is a follow-up on that. Assuming gold will do well, is physical gold a better option, or we should bet on gold mining companies?
No, gold mining companies have not delivered on their promises because every time there is a gold boom, they go ahead raising capital, doing all those nonsense things, and that is why market does not give them a multiple. So they have not delivered historically on the promise of a higher commodity prices. This is where I will stop. I cannot give a view beyond that.
So there is a famous saying I'm reminded of, I think it was somewhere in California, where it says that wherever there is a gold rush, look for pick and shovels rather than the mine. So next question, I think, is from Chirag. View on global liquidity contracting or expanding. How can we track it? Any sources? Yeah, this
cross-border capital. Go to cross-border capital.
Okay.
Okay, Michael Howell or cross-border capital. But only if you look at chart, you will not be able to understand. You'll have to listen to his interviews. Okay. Look, there is no need for me to do all the work myself when somebody is an authority on that and puts a lot of it in public domain and give interviews. Okay, with fantastic charts over there. You should actually follow these, him and his company for this thing.
Right.
Sorry, Ankit, I can take only one more because I'm not well. Okay, I'm not able to speak out this.
No problem. Anyways, we have exhausted all the questions. So thank you so much, Ritesh. And
great.
Thank you so much, the audience, for asking some really good questions. And for all who are watching this now, we'll put up the recording on our platform tomorrow morning. So you can watch the recording even if you have joined in late. Harshal, you can just, Harshal has just shared the link where you can just enter and watch the recording. Okay. Thank you so much, Ritesh, for this lovely, insightful session. Thank you so much, everyone.
Thank you, everybody, and good night.
Thank you so much for watching this session. If you like this session and if you want to watch more of such premium content, then you can become a part of our Mission Smile community just for free. And fun fact, you can watch all this premium content without any irritating ads that you get on YouTube. So link is in the description below. Do become a Mission Smile member. Thank you.